Good morning, I'm Jane. So if you would like to sum up first half in just one word, what would it be? I believe many of us are already bored with the headlines that come with tariffs or uncertainty. And this leads us to actually sum up first half in just one keyword, which is volatility. And this has not been easy. But in today's session, with all of you here today, it's quite a good time where we can revisit what we have been through in the first half and how we can position ourselves better in the second half. Just to bring you up for this topic today, I actually designed this topic in a way that relates to how we actually treat our relationship, just like investment. So in a relationship, think about the good old days when you are dating or you are looking for your ideal special one. You are looking for the one person that could actually go with you throughout your whole life. But in investment, typically one is never enough. So this session would like to actually discover what are the opportunities out there beyond just US, beyond just tech. So let's go through quickly with the disclaimer. So this session may not constitute any buy and sell call recommendations. And with that, let's quickly recap. In the first half, we all started with one person that came to the center stage, Trump. What did Trump do to all of us, to every country? He is setting an extreme level of tariffs, which in some way could be very detrimental to US and also the foreign relationship with other countries. I think some surprise to us is that after the election, the market actually rallied through until Trump actually took office, I think around mid-January. And ever since then, we actually experienced a brief bear markets, not only US, but also in China as well as the rest of the world. But that doesn't actually count us out of investment. If you actually exceeded the market because of this choppy moment, because of the sell down, you would have disappointed and regret on your move, just like in relationship. But don't ever look back, look forward. If you stay in the game and you invested long enough since the bear market, you would have recovered meaningfully from the dip, and now you could be sitting in a positive gain. Look across the boards. We have markets that actually recovered sharply. For instance, those laggards, those markets that actually only experienced low single digit to high single digit growth, this year, they turned out to be the top performers. To name a few, we have South Korea, China had shares, and also Europe. These countries, to our surprise, they actually make it to the top list because of their valuation. They were actually traded at a much depressed valuation compared to US, when a lot of capital actually go into US and tech and not into these countries. But this year, we are seeing that markets actually appreciate the fundamental strengths and also the conviction we have for these countries. So in short, there are 4 key trends you could not ignore when it comes to investing for the second half. We should not actually spare ourselves from the potential heightened trade war. Currently, we are still comfortable with the 10% tariff that applies to everyone. But the catch is here. There's always hiccups along the way. So Trump actually initiated another round of reciprocal tariffs for 14 countries, including Malaysia. So this one did not actually come to surprise and is not expected for most market players. So this actually signaled the alarm that you could not actually go easy with Trump when it comes to trade leverage, because it's one of the most powerful negotiation tools that we have seen so far for many decades. Also, US dollar has actually weakening over time. So this may be elaborated later on, and this actually built the case for your portfolio where you should look opportunities beyond just US. All this tariff concern uncertainty that actually leads to one thing, which is your growth expectation now is getting lower and lower. So for US, we see first quarter, the US GDP is actually at minus 0.5. It's a level that you could not imagine if you were still in 2024. So could you give a guess, like in 2024, what was the GDP growth for US? It's actually above 2%. That was quite huge, and actually it shows the underlying consumer strength that actually hold the economy throughout 2024. But when it comes to tariff headwinds, a lot of countries that actually trade with US at a high scale, actually they import or they expedite their imports from to the US in the first quarter. And in the second quarter, a lot of exports actually have come down. And actually they have tried to review their business plan, whether or not they should continue produce at this scale, given the tariff uncertainty. But what is not stopping us from investing? It's actually the momentum behind tech and AI. If you are a tech-savvy investor, or you are someone who believes that tech is something that could change the world, as what we have experienced since dot-com bubble, this is something that actually comes with competitiveness and also innovation. So the capex behind AI is not just a number. It's a real thing that could drive more investment into this space, be it from infrastructure or be it from the software part or cloud services. It's all to change the world for a better future. So in short, if you would like to take a quick look or quick picture of this sum up our investment outlook that could help you to navigate the volatility better for the second half. One thing that could stand out perhaps is a new world order. You may be curious, other than US, is there still place for us to invest? Is there still good opportunity for you to capture that is as good as US? Well, don't be worried. Once you take the picture, let's go right into how do you interpret a new world order. I assume after tariffs have been announced in April, if you were in the market, I believe that every morning when you wake up, you'll be thinking, is my portfolio still sitting in the red? Well, this has to be done with the reciprocal tariff, which is a crazy numbers that Trump has actually floated somewhere around early of April. Everyone was so surprised. Malaysia at that moment was receiving around 24%, while China was the one taking the greatest hit. But fret not, he actually reversed the policy, actually reduced it to around only 10%. 10% for all countries for 90 days. And the 90 days is what? It's actually a honeymoon where most markets, be it US, Asia, or Malaysia, we all actually try to recover and rebound from the dip. So take Nasdaq for example, the tech sector itself, ever since the Liberation Day in April, the market has actually rebounded close to 36%, while Korea itself rebounded 40%. If you were to stay out of the game and try to exit this choppy session, you would have missed out all the gains and your portfolio could still be sitting in the loose. So in short, now we have already passed our honeymoon. What is next is actually another deadline. So we are still in the counting down game. But fret not, we believe along the way, there are still time and there's still a huge window for us to negotiate with US to actually gain better trade terms. So for US, why is it sitting at a weaker point at this moment? Why is Trump keep using tariff as his strongest negotiation lever? Just by looking at the number itself, you may be shocked that Europe as a region actually trades at a higher scale with US. But when it comes to trade deficit, which means how much US is losing relatively compared to each of the region, China came into the picture. China is actually the main target that US wish to actually alienate it or isolated with the world. So looking at the numbers, it's actually quite high at about 260 billion of trade deficit with the US. China is likely to face a blanket tariff of 54%. That is if they fail to actually achieve a trade deal with the US by August 12th. This is the special treatment for China, which is in a bad way. So we cannot just treat tariff easily, given that the numbers are quite sky high. Imagine this number has been transferred to the goods that you buy every day, to the goods you buy at grocery or the oil prices that you take at the pump. It's quite painful, and I'm sure that the inflation number would not be that rosy anymore. It could go beyond 3% level. And Malaysia, you may doubt, where do we stand? Are we also the victim of this trade tariff themes? Perhaps Malaysia at this scale, compared to the rest of the big country, we are still quite mild at about 25%. But that's not something to be happy about, or not something to be cheered, because we have a quite substantial amount of electronic exports where we re-export to China. And this is our weakest point, where US has been trying to attack and also trying to negotiate with us for a better terms. Just to flash some latest news, just a few days ago, US actually initiated another negotiation bullets. It's actually asking us to actually loosen or trying to expand our foreign equity ownership limit for certain key industries. So this is one way where US, Trump specifically, when it comes to tariff, he's not looking at just tariff or trade itself to not only win in this just aspect. He's actually trying to use this as a bullet to actually negotiate, to actually has a better competitiveness in other countries. For instance, trying to invest more and trying to influence more in terms of capital injection in other countries, especially when it comes to Southeast Asia. Well, this leads to the concern that US in this moment, if imagine your country is receiving or it's actually taxing others for this kind of imports at this level, you could risk yourself into stagflation. So stagflation is actually the worst thing that we could imagine if tariffs continue to keep at this high level. Stagflation is a function of both, where you receive super high inflation, we call it hyperinflation, while at the same time you are not receiving any growth at all. So at this moment, just take a moment to pause and think about 2024. Where were we? We were in a very sweet spot. We are in a spot where we actually enjoy moderate inflation, while at the same time the growth is keeping up. But when it comes to this year, as of current, we have seen inflation did not make any retracement meaningfully. It still stayed at around a level that is quite concerning to not just Fed policies and also to us as a consumer. While GDP, as I mentioned, is still in a negative zone. But when it comes to Q2, we expect the numbers wouldn't deviate too far away from this, given that much of the growth expectation has been actually revised lower. But fret not, there's also a bright spot we don't want investors to actually ignore at this moment, which is tech capability. And also US, as the center of innovation hub, if you want to have a leverage or exposure to AI, you wouldn't want to miss out investing in US. While at the same time, you may diversify to China tech or to Asia tech, but you could not miss out US tech given its ability on technology leadership and also its ability to scale capex more substantially compared to the rest of the world. Well, another layer of uncertainty after stagflation risks actually loom over the US is actually the one big beautiful act. If you follow closely with what Trump policies has actually rolled out, this actually sends more worries of a US fiscal deficit. In short, that means if this plan is signed into law and actually in effect in US, the US could be paying $400 billion more in interest burden in the next 10 years. That is a sky-high number, which in a chart, we can just simply imagine this. Without this act or without this policy, the US would already be standing at around 150% level of their GDP in terms of public debt by 2054. However, with this act coming into picture and in effect, not just policymakers, businesses, and us as an investor, and also expecting current interest rate to stay at a level somewhere around 3 to 4%, we could be seeing that the public debt as a percentage of GDP going up as high as 218%. This is a huge gap compared to the situation where this act is not being considered. Hence, however, the thing has been done, the act has been passed in the Congress, and we are likely to see that the US would be more careful, and also the treasury yield for US bonds is likely to remain elevated for the coming decades, given that inflation expectation has been priced in, and also people are preparing for lower growth and higher inflation economy. That leads us to something that is already shaken, that's already being challenged, which is US dollar. Just put this in a simple word. If you have US dollar assets or you invest in any US stocks at the start of the year, even though the stock is not moving at all, you would be already losing in terms of your currency appreciation in ringgit. Means that it's about minus 10% loss in your USD assets, because given the weakness in USD and also the sentiment has been growing even more bearish for USD. The chart actually illustrates a very interesting things that actually happened in the first quarter, where a triple Q moment, we name it. So it's the moment where stocks, bond yields, and also dollar fell all together at once. This is actually against the textbook theory or something that we actually have been seeing over the decades. So what it actually means, when stock go up, bond yield is likely, when bond yields go up, stock is likely to retreat, given that people are actually quite risk off, are trying to actually invest in place that is more safe. While at the same time, dollar in these instances, when stock actually goes up, dollar should be moving sideways. But when dollars goes up, it means people are afraid. They park your money in US dollar because it's a safe haven, if you name it. So this situation actually defeats all the textbook theories, and this actually leads to further bearish sentiment that grows within US dollar itself. But in the long run, we don't really see any other currency that we have right now could replace dollar. Not yen, and not yuan, and not euro, because they used to be official reserve in the past, if you recall, but their advantage is not as strong as dollar itself. They actually failed to become to actually compete with dollar in terms of global official reserve. While at the same time, dollar is still favored as the best currency to have for most trades and most reserve around the world. But that shouldn't defeat the case where you shouldn't invest US at all. US at some point still have bright spots to shine. For instance, looking at this chart is how much the market cap in the world has actually grown over the years. Just from 2024, from a low of like 90 trillion, as of today, you have seen it grow above 120 trillion, with most of the market cap that actually go beyond $1 trillion market cap, are those come from US, be it NVIDIA, Microsoft, or Amazon. That actually paints a good picture when it comes to having some exposure to US, but not excessive. So we are not asking you to go all in, but at the same time, do not try to avoid it at all. Having a selective exposure where you deem is okay for your risk appetite is still actually advocated. Just looking back historically, where US stand compared to the rest of the world is still quite exceptional in the quality of the assets, quality of the companies, as well as return on equity. It's still something that you should actually pay attention to, actually have a part in your portfolio. So talking about US, we can't just simply run away from the lifeblood of US, which is digital economy and semiconductor. Well, these two things are quite interrelated, and essentially they are global in nature. But what we talk about, what I bring up the idea is that the AI infrastructure spending, be it data centers or softwares, majority actually comes from US or driven by US itself. While semiconductor chip manufacturing, this thing you may be familiar with TSMC, which is one of the company in the world, it's quite rare, that have a near monopoly status in these instances, close to 70% of market share, while other companies have close to low single digit of market share. So we are seeing that semiconductor itself is not just concentrated within one or two countries that actually can exert influence over pricing, over the production itself. It's actually an integrated supply chain, where by having exposure to tech, you're essentially exposing yourself to actually capture potential alpha or potential return from all over the world. What else beyond US? And it comes to the picture is one theme that you shouldn't actually forget in the second half of 2025, where in first half, it has already shown its resilience to generate close to 20% of return in first half, which is Europe. But when it comes to Europe, we would like to advocate a more thematic exposure, given that their defense spending is actually growing rapidly and trying to achieve on the same par with the US. So this essentially paints one thing. the region has come together to acknowledge the potential impact of tariff that could actually weaken their leverage in terms of growth or in terms of trade competitiveness. So it's a wake-up call. It's a wake-up call where they should diversify their trade partners while at the same time pursue a more coordinated fiscal reforms with the most straightforward ways being improve their defense spending capability. So the rearm Europe being one of the example where they are likely to invest a lot in defense in order to actually shoot their competitiveness with the US. Another bright spot that we all familiar with, which has already been a sleeping giant in the past 3 years, is actually China. So China this time, we term it as a dark horse. If you follow us through WOW-T in January this year, we actually frame it as dark horse, and it has not disappointed us. So China is back. In second half, our expectation is stronger policy tone, while at the same time doing more to avert their deflation issue. Deflation can actually, I want to bring out one buzzword that is actually quite happening and quite popular in China right now, which is involution. So we're all familiar with evolution in tech and AI. But when it comes to involution, what it exactly means? It's exactly the opposite where China is experiencing right now. Just think about the price wars in EV, in e-commerce. They are slashing prices in order to win market share. This does not paint a healthy competition moving forward. It should actually disrupt the competitiveness in China where smaller players with more innovative ideas are actually being crowded out. So we do not want this to actually continue. What China has done, just to fresh out the latest news, that China is actually trying to impose more export controls for EV batteries. Means for the foreign companies, foreign investors who actually want to tap on Chinese technology in making EV battery, they need to apply license. And China is trying to limit this at its best. Given that China has close to 70% of market share in EV battery, hence this is one way where China is trying to actually boost innovation, while at the same time asking the companies in China, don't just look at cutting your prices to win market share, but trying to improve in innovation and technology capabilities. Well, the other thing that I want to touch on is actually Japan. Japan is also not being spared from tariffs this round. So Japan has a lot of exporters in Japan. They are quite honest. They have been upfront saying that this kind of tariff could actually hurt my earnings. And these are the numbers that I would like to share with our investor, where Toyota, Honda, they're also quite concerned that tariff could actually eat into their margin, actually hurt their global competitiveness. Even when we are actually experiencing the 10% tariff for most of the countries, some industries they're actually receiving much higher tariff. With one example being automakers. For Japan automakers, they are standing at around 25% tariff, which in some way can be absorbed easily by most automakers, given that their car prices are made, given that their advantage is in terms of cost effectiveness. The other one that I want to bring out is the yen strength. Yen has been quite strong in somewhere around second quarter, touching about 140 level against US dollar. But now it's actually retreated back to close to 150 level because of uncertainty surrounding the upper election that is going to take place in Japan. So we expect further, moving forward, Japan remains something that you should actually acknowledge and have it in your portfolio. But in the short term, be upfront that the range-bound trading is still expected, given the uncertainty has not settled down, both on the trade front and also the political front in Japan itself, where the parliament is actually debating whether they are able to secure a simple majority. So with that, I would like to flesh out one idea to actually sum up the session today. In short, you need diversification in your portfolio. And how to do that and how to leverage on that very important idea is that you can actually refer to our star rating table, where have been shown up here. Our very bullish view still cement around digital economy, Japan, Singapore, and South Korea, where they have shown their capability in terms of semiconductors and also tech innovation. While this one, to leave this quote with everyone, a ship in harbor is safe, but that is not what ships are built for. To invest in the long term, the key is to adopt and not avoid. So with that, I would like to conclude my sharing. And with that, happy investing and invest globally and profitably in the second half with our investment outlook. Thank you.